I have to ask why you like China at a time when we continue to see the stress in the property sector, even Chinese leadership coming out, not really announcing any new measures at this point.
Well, China has always been one of our favorite areas in terms of Asia, and it's really had, a very tough time the last few months, last year, and we think, especially with the zero COVID policy, but we're seeing the kind of the light at the end of the tunnel with hopefully there will be less drastic measures in terms of COVID restrictions, and people are coming out of the lockdowns and business are coming back, and we hope in the second half, even with the government not announcing any policy support, but we feel like that should come in the way in the second half, and there should be more growth in the e-commerce sectors, in the gaming sectors, in some of the sectors that really gotten beaten up in the first half this year. So we want to focus a little bit on the growth and the potential in China.
We have seen the leadership talk about really maintaining that reasonably ample liquidity, but I wonder who will take it, given that this chart on the Bloomberg just shows that interbank rates continue to fall as there is money out there, but banks are not really taking this. The demand for loans pretty weak.
Yes. Yeah, the demand of loans is for weak. I mean, a lot of, one of the biggest concerns we have with China right now is the property markets, and that could definitely have spillover effects into banking, into the debt system. So we are hoping that the government will eventually step in and provide some type of policy support in those areas, and maybe, help with some of these areas for some kind of recovery.
You still quite like commodities and oil, even with the recession risk?
Yes, there's been a recent drop in oil and commodities, but still supply is very much in demand right now. So there's, with the reopening of the economy and that, that is still going on, even with all the talks of the rate hikes and everything, going into the second half, I mean, we still see about a 10 to 15% upside in commodities, especially with a recent drop in commodities.
I assume that means you're quite constructive on Australia then?
Yes, we do. We like Australia. We also like British equities in addition to China.
What about fixed income? What opportunities are you seeing in there?
Fixed income, it's one of those. We're still very focused on short-dated bonds, very short-term bonds, because of how fast rates are going up. But we are getting in. And we feel like there is a little bit more opportunity in probably some of the prefers, some of the longer term bonds now. But in the near term, we still want to stay very short on with fixed income.
And we are seeing broad upside across equity markets, across Asia, across the U.S. It seems that recession risk for the U.S. has been priced in. What are the economic concerns going forward that could really cause more volatility in the markets?
Yes, with the Fed meeting yesterday, I mean, I don't think the Fed made any specific indication what is going to happen with rates. The Fed is less hawkish, but I think it really depends on inflation. That is their number one goal, is to fight inflation and to bring inflation back down at more sustainable levels. So it's really going to depend on economic data. It's going to depend on the August CPI numbers. It's going to depend on the jobs numbers, and that's going to ultimately drive the decision on the Fed. And so with all the rate hikes we experienced in the first half of this year, I mean, it's going to have a longer term impact on the economy. And so we are neutral on equities at this point. We are expecting markets to remain volatile until we have a better idea of the pace of the rate hikes. And regardless, I mean, it's going to have a longer term economy. So the slowing in growth is going to stay for a while. And so we just, advise our investors to be cautious and to position their portfolios that can stay strong in all scenarios.